Welcome to The Explainer. On these big earnings calls, I always say, forget the prepared remarks. We're going to skip all that today and jump right into the good stuff. The unscripted Q&A with Wall Street analysts from Goldman Sachs' latest call, because that's where you really find out what's going on.
Right. This is where the rubber meets the road. The executives get put on the spot, and you start to get a glimpse of what's actually on their minds. Things like the market, where they see growth coming from, and of course, the risks they're sweating over. So, let's get into it. What did they really want to know?
Okay, first up, the big theme was all about risk, vigilance, and opportunity. The CEO started out with this kind of cautious tone about the market, and you can just imagine the analysts perking up, ready to pounce on that.
So David Solomon, the CEO, says, "We are especially vigilant in times like these." And of course, the second an analyst hears that, especially with markets at all-time highs, the immediate question is, okay, vigilant about what? What are the specific risks that have you on high alert?
And they didn't waste any time. The questions immediately zoomed in on the private credit market, which has just been absolutely booming. You've seen the headlines. Analysts were basically asking, hey, are there some hidden risks bubbling up on your balance sheet because of this? They were particularly interested in their lending to other financial players.
So, how did Goldman respond? Well, their whole message was basically, we've got this. It's all about prudent risk management. They talked about strong underwriting being the core of everything they do. They said their book is super diversified, mostly investment grade, and importantly, that they have no direct exposure to some of the troubled names that have been in the news. They even pointed out that client demand is way higher than their lending growth, which is their way of saying, see, we're being selective. Even their use of complex tools like synthetic risk transfers, they just brushed off as ordinary course risk management. It was a very clear message. This is just business as usual, not some panic move. It's a fascinating dynamic, right? A cautious message, but delivered with this real air of confidence and strength. Okay, so after they got through all the talk about risk management, the whole conversation kind of flipped. It pivoted from defense to offense, to the massive opportunities they see on the horizon.
And what's driving that optimism? Well, it's this number, 3 years. That's how long it's been since their investment banking backlog was this big. And you've got to remember that backlog is basically their pipeline of future money. It's all the mergers, the acquisitions, the IPOs that are lined up and ready to go. A big backlog means big revenue down the road. So the deal pipeline looks strong, but the analysts wanted to know, beyond that, where is the real long-term growth going to come from? And man, the answer could not have been clearer. It was all about one specific division.
Check out this number, $3.5 trillion. That is a mind-boggling amount of money. And that's the record amount of assets they now have under supervision in their Asset and Wealth Management Division, AWN for short. This right here is the growth engine they are putting all their chips on. And not only is it their main engine, it's an engine that's hitting the accelerator. I mean, after a record-breaking quarter, they just jacked up their 2025 fundraising goal. They're now aiming for $100 billion. That's a huge jump. And it's all because demand for things like private equity and private credit is just off the charts. Okay, now this next number is really, really important to understand. $4.6 billion. What is that? It's basically money in the bank, just not in the bank yet. It's what they call unrealized incentive fees. So think of it like this. It's a giant pile of performance fees that they've already earned on their investments, but they just haven't cashed the check. It's pure future profit, just sitting there, waiting to be realized. So they're growing like crazy organically, and they're making smaller, smart acquisitions. But the analysts, they're always thinking bigger. They wanted to know, hey, are you guys going to go out and make a massive deal to get even bigger, even faster? And the CEO's answer here was really telling. He said, the best businesses, they're generally sold, not bought. It's a great line. Basically, he's saying the really good firms aren't for sale, so you can't just go out and buy them. While he didn't totally rule out a huge deal, he made it clear the bar for that is incredibly high. For now, their focus is on these smaller surgical acquisitions that make their platform better for their super rich clients. All right, so we've got risk management and a booming wealth division. The next big topic that came up was about a huge internal change. And analysts were kind of scratching their heads, wondering why, with revenues looking so good, they were suddenly talking about a big efficiency push.
What they announced is this new initiative called One Goldman Sachs 3.0. And it's a pretty ambitious multi-year plan to completely re-engineer how the entire company works, from the traders on the front line all the way to the back office, using a whole lot of AI.
So why do this now? The CEO was really careful to frame this correctly. He said, look, this isn't as cutting costs because we're in trouble. He positioned it as a proactive move, something they're doing from a position of strength. The whole idea is to use AI and automation to get way more efficient. And if you're more efficient, you free up a ton of capital that you can then turn around and invest right back into those big growth areas we just talked about.
Okay, the next piece of this puzzle is maybe the most important of all. It's the thing that really underpins their whole optimistic view of the future. And here it is, the regulatory world. According to the CEO, things are shifting big time. What used to be a major headwind, something slowing them down, is now turning into a tailwind, pushing them forward. You can't overstate how huge of a change that is for a bank like Goldman. He basically argued that with progress expected on all these complex banking rules, Basel III, SLR, all that stuff, it puts them in a much better competitive spot, especially against non-bank lenders. What it really means is they can stop spending so much time and money playing defense with regulators and start using those resources to go on offense, serving clients and really going after growth. It could even mean they can run with less capital tied up, which is a big deal for profitability.
So it all sounds pretty rosy, right? Well, not every single question got a nice, neat answer. There was one topic that was left. Well, let's just say it was left hanging. Yep, the elephant in the room, or I guess the elephant in the wallet. The Apple Card. An analyst just came right out and asked it, should we still expect you guys to get out of this partnership? And the answer? A total shutdown. I don't have anything more to say on the Apple Card program at the moment. That was it. A classic non-answer answer. It confirmed that, yeah, consumer credit cards aren't really their focus anymore, but the fate of this one very famous card, still totally up in the air. So let's pull this all together. What did we learn from the Q&A? We saw a firm that is projecting a ton of confidence. You've got this picture of a company that feels like it's handling near-term risks, but at the same time, it's playing offense on M&A, it's flooring the gas pedal on its asset management engine, it's getting leaner with AI, and it's catching a nice tailwind from the regulators. Pretty much everything's coming up Goldman, it seems. And that really leaves us with a million-dollar question, or I guess for Goldman, the billion-dollar question. They're projecting all this confidence and growth right when the market is at all-time highs. So is that a sign of incredible strength and insight? Or is it a massive blind spot? Are they underestimating the risks out there? That's the real takeaway from what the analysts were trying to figure out, and it's the question that's still hanging out there.